Investing insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
G'day everybody, Steve Waters and Victor Kumar back again for our recorded version, our film version of Investing Insights with Right Property Group. And Vic, it's now been a month since we've done this.
That's right.
A fortnight since the last podcast, but so much has changed once again. And I feel like I say that every podcast, but more so than ever now, every week is a different ecosystem.
Yeah, the market's shifting quite rapidly. A lot of buyers jumping into the market. We would have thought that by now the New Year's resolution surge would have stopped, but it actually hasn't.
No, it's a good point, actually. I think, Christmas didn't feel like Christmas.
No,
and
it didn't.
2020 didn't seem like 2020. It's almost like we've rewound all the way back to that moment in time and we're having another go. It's like, let's just rub that off the board and let's move forward. And all markets are sinking.
Yeah.
For the first time in a long time.
That's not SINKING. It's SYNCING.
Oh, yeah, true
right?
story. Yeah, all markets are not sinking. All markets are rising collaboratively across the whole country, and it's been many, many decades since we've actually seen this. And I don't think there's one major market that has gone backwards in the last 6 months.
No, and who would have thought, right? If you rewind back to this time last year, it was absolute doom and gloom, and there were talks of 60% plunges and 40% plunges, and it was like a countdown, and it went the other way around. And now we're starting to see double-digit predictions of growth.
I think it's every time there's a little bit of a market in flux, the journos go to the contacts in the phone and go, who's the most negative person that we can always rely upon to give us some headlines and talk about just how much we want to stick a fork in our eye because everything's going to collapse. And it's the same people every single time there's a little bit of negative potential news out there. But it's certainly been very different than what was most predicted. We weren't one of those. However, to be fair, whilst we were very buoyant and bullish on what would happen, this is beyond our expectations as well.
Yeah. Hey, did you see the news articles that what we talked about perhaps late December, where they're saying the markets are very, very similar to 2003 and everything's coming together?
And it was in the headlines.
Yes, that's
we were
right.
talking about that a couple of weeks ago. And it very much is. And for those that maybe weren't around back then, it was an enormous bull run in terms of asset values. And I don't think that we're going to experience that type of literal 100% growth in some markets in 12 months. We're not going to experience that.
No.
But what we are experiencing is above normal and we will take it, but as long as we always plan for the future, as we always talk about. So before we get into our subject, what have you been seeing in the markets over the last fortnight?
Look, certainly you can see that there was this talk about more stock coming on the market, but just as more stock comes on the market, there are more buyers coming to the market as well. Mortgage rates are really high in terms of the number of people taking out mortgages for own occupiers. And certainly the home upgraders, the move interstate, the buying that perfect home seems to be on the cards more and more as people get set into, let's do something for ourselves. And I suppose they've got a lot of disposable income because they can't go overseas at the moment, so plow it into property.
And that is a part of the pie. As is, you mentioned about stock on market, where there was a little bit of narrative around, well, we think there's going to be more stock on the market because one of the indicators, CMA reports, have started to increase, which is a prerequisite for probably over 90% of buyers agents when they're going to a seller to potentially sell their property. Sign with us, here's a CMA report. So it's a leading indicator on what potentially could come onto the market. But you made a good point, whilst those CMAs have increased slightly, maybe there is some more stock on the market, but not enough to be sort of high-fiving over, because there's actually more buyers in the market that's taking up that small increase of listings. And the other thing is, I get a question quite a lot, is why aren't people selling? Like, why aren't they taking advantage of potentially a good moment in time in terms of achieving a sale result for their property? And what I put it down to is they want to experience more of this accelerating market because it means more asset value before they sell it.
Yep.
But also the big thing is if you've got an upsizer, downsizer or a sideways sizer that is wanting to move into something else, and if it's not there, they're not going to sell what they're already in.
No.
So it's a bit of a sort of inflection point. Which comes first? Do I sell my home then look, or do I actually see that there's more on the market before I sell mine so that I'm not caught in no man's land?
Yeah. Plus the mental game that people play with themselves, right? If I sell now, what if I miss the growth that's going to happen for the rest of the year?
Could also be that with the whole sea change, tree change, that people are just saying, well, before I sell my property, I might just wait and see how this pans out, whether it is feasible and sustainable to actually move to these areas and my employer or my business will cater for that.
Yeah.
So I'll just hang back a bit. And these are all the unknowns, which are always there, just different trigger points. And we deal with what we can. We know that the cost of money is low. We know that consumer confidence is extremely high. High search intent activity is still very high. There's a lack of rental properties in the good located areas. There's a housing accommodation crisis.
Correct.
And we talked about that 18 months ago.
That's
well
right.
before COVID. And it's all come together. We often talk about these ingredients in the pot. And sometimes there's always one or two that are missing.
But everything's come together perfectly.
I think they're all there now and everything's just cooking. Yeah, the cake is baking, so to speak. But none of it means anything if you can't get your hands on finance.
Exactly right.
And so today we have a special guest, which Vic will introduce in a minute, who's a seasoned investor as well. But because finance is such a critical part, we can have all best intentions, but if we don't get credit, if we can't buy the debt, we can't buy the property.
Exactly.
So
it's a game of finance.
it's a game of finance. So I thought we would collate 5 absolute finance musts to allow you to be able to protect and enhance your borrowing position. So how can we move forward as investors? Because we do want to buy 1 or 2 or 10 properties, whatever it looks like to you. But once again, we can't do that without debt.
That's right. So we've got Sze Chuah, who's been sitting around patiently waiting to be introduced.
While we gibber on.
Yeah, gibber on. And Sze is the head at MLS Finance, a seasoned investor and a really, really good broker that I've seen him do amazing things with finance. So welcome, Sze.
Thanks, Vic.
And how are you finding the world of finance as in sync, as in SYNC, with the market itself?
Is sinking.
Yeah, look, it's kind of an interesting dynamic because it not only feeds into the property market, but it's sort of influenced by the property market as well. So there's an interesting dynamic there where, last year there was announced there's going to be sweeping changes. I don't think the changes that have happened since and are probably going to happen from here on in are as prominent as what they would have imagined because of the pace of the property market. So I think there's that sort of dual impact both ways.
So what you're referring to there for the listener is that change over from responsible lending to responsible borrowing and how it was really, it was talked about, although as it was going to be this
magical
major
switch.
Yes.
magical switch, but someone already turned the light on.
Yes, that's right.
Before. And now I think in the back rooms of the banking systems and APRA and the like, they'd be going, well, maybe we don't need to make as many of these changes because it'll only perpetuate an already very strong market, and we need to be a little bit more granular about what changes we make.
But having said that, they've already promised that there will be changes. And to be fair, I think there are a few changes that they're tinkering with, the banks are tinkering with, and what they're being allowed by APRA, ASIC and so forth to be able to do, I think they're going to want to do, especially in light of the current environment where the turnaround times for assessment and getting your loan application approved are blowing out more so than ever.
So is that a combination, though, of potentially resources at hand within the banking system?
Yes.
In combination with just how onerous an application is.
How onerous the application is, and also the volumes. The property market is insane, and a lot of that is to do with a lot of confidence from buyers. Everybody wanting to, I want to get in, so the first thing I need to do is get my finance in order. They're getting pre-approved. Right, so if a lot more people are getting pre-approved, the queues are longer. It's taking longer for your application to be assessed. So that's what we're seeing.
So when we talk about applications taking longer, give us some ballpark numbers. Look, for a pre-approval.
For a pre-approval, some of the even mainstream major banks, you're looking at anywhere from 4 to 6 weeks for an initial assessment. So from the time that your financier hits submit on their system for your loan application, it goes across to the lender. 4 to 6 weeks it takes for it to go through a queue and it to be assigned to an assessor, and for the assessor to come up and have an initial look at it.
It's crazy.
Yeah, let alone any questions that they might ask. They might just say, okay, show me some additional documentation, ask other questions about your situation, and then it goes back into another queue. It might not be a 4 to 6 week again, but it might still be another 2 to 3 weeks.
Yeah. So and by the time the pay slips would have expired anyway, right?
That's right.
And you start again. So it's a real moment in time, damned if you do and damned if you don't, because as investors or homeowners, purchasers, I should say, we really do want a pre-approval because that gives us an element of safety.
Yes.
However, if it's going to take me 6 weeks to get a pre-approval, the way the market is moving, that might be a couple of percent in asset value, or even, let's say, more lack of choice. Or we say, well, we'll go to the market and we'll start to negotiate something, purchase something, because when we have a contract of sale, there is the chance that our application then will be
gets fast tracked
and what have you.
Escalation process.
Yeah,
and this situation is being made worse, especially for your audience, because a lot of the applications that your listeners are submitting are complex applications, deemed complex by the banks. So they go into a separate queue that definitely take the 4 to 6 weeks, rather than just that's first homeowner, fantastic income. They're going in, they're buying in trusts, or they've got a portfolio of 5 or 10 properties already. They're doing a simultaneous equity extract plus a purchase. So they're going into these other queues that are even longer and slower, because the credit assessors are a specialised team. They're senior credit assessors, they're credit managers that are used to dealing with these and have sign off on a more complex deal, basically.
Whilst on the surface, like as you were saying that, first of all, I was thinking, who'd want to be a broker?
Yeah.
The second thing I was thinking was, it just shows you the complexity of an application in behind the scenes that I would say that over 80 to 90% of people wouldn't even imagine actually happens in the background. And so if you go over the counter to Bank One to get your pre-approval rolling, without any disrespect to the people on the other side of the counter, but it's just a number, it's just punching numbers into a calculator with a yes or no. Whereas when you have those levels of, you said complexity, I like to use the word sophistication.
Yes.
It shows you that you need the specialist in behind the scene to not just expose you to other lenders,
but to structure it properly as well.
But to structure, because the way I look at it is every finance application or proposal is a business proposal. It's like you need to create it in its best possible light to get the best possible product and to get the result. But there is an element of complexity or workload behind it, which is clearly bogging down the ecosystem.
Yes.
It just doesn't make it any easier for buyers. So look, some of the non-negotiables for me, if you went to an auction without finance approval,
you're mad.
Yeah, you're an idiot, because you're rolling the dice, and it's a very dangerous set of dice to roll. In a perfect world, I'd always love a pre-approval because it gives me security to move forward and make the right decisions. But maybe in today's market, I need to be attacking it from both ends. So that means I'm on the hunt for the property, whether it's an investment or a homeowner property, but I've got the broker in the background
I think
going as hard as they can.
that's a really good point, because that gives the broker and the bank a little bit more impetus. Like you mentioned, if you've started your search already, then and you sort of do that in conjunction with your finance application process, I think you're going to get a better outcome, because one of the things you could do is select an area, which you guys would do anyway, and even if you're not buying that property, speak to the agent or grab a contract of sales, even if it's blank, and just shoot that over to your broker, and for them to at least pre-position the lender with, because A, you may skip a queue. Worst case is B, they know the type of property that you're looking for, the type of, obviously the area that you're looking in, and if you're going to hit any roadblocks with, for instance, postcodes or high density or anything like that, then that way it can be sort of nutted out early.
So this is where you as a broker come in, and we've had several conversations around this in terms of our clientele, is that when the approval or the lender is being sought,
yes,
we are also looking at where we're looking in terms of the property, because the lender might not like that area.
Exactly.
Or they might have a requirement to have a higher yield on a property, which might not be actually possible on the ground.
Yes.
So this is where it's really important to understand the type of finance that you're getting.
Yes.
And more, as we were discussing, we're starting to see people releasing their equity early.
Yes.
So that, in the absolute worst case scenario, particularly with the auction type of scenario, you've got the ability to pay cash for that property if finance doesn't come through.
Falls over, yeah, that's the worst case, the backup. And I think you really hit a good point, because we're finding by working in closer with our property group partners, we're always getting a better outcome for our clients. So we're talking to you guys about, you're looking to put a granny flat on this property. Okay, these lenders aren't going to be good, or this lender's going to be better, or these lenders don't even do construction finance. You guys are thinking, okay, well, we're going to buy this one and another, so we've got to release more equity up front, or we've got to go 90% rather than 80%. So, that close collaboration in this market is really, really helping us.
Yeah, I would say that type of collaboration in any market is absolute necessary, but more so today. So those, and maybe just as a tip, if you have got a broker, make sure that the lines of communication are open and that there's no third party privacy issues, and that you've given the necessary permissions.
Yes.
And just as importantly, make sure there's no egos on the table as well.
It can come down to the most minor detail, but that could blow your finance application out of the water, because if you've made an application in, say, husband and wife's name, they go through the 4 weeks, they get pre-approved, and all of a sudden the buyer's agent says, actually, I think this property is a really good property, but for your trust, all of a sudden it's a completely new application. That previous application that you did and you got pre-approval on, you throw it out the window.
Yeah, it's a moot point.
Exactly.
Correct. So one of the things you mentioned earlier on was around product selection, and we'll get to the 5 points in a minute, but the point I wanted to make now was don't be rate orientated, don't be rate focused. The best rate isn't necessarily the best product for you or your portfolio, or for that particular asset selection, if you will. Do you find that a lot of people are more rate orientated today versus, say, 4 years ago when rates were at 5 and 6%?
Yes and no. I think there was a period of time over the last couple of years where rate was in the media a lot, and as rates were falling, customers will always want to get the best rate. Rate will always be important. It drives your repayments, drives your future serviceability. So it is always important. But I think of late, over the last 6-12 months, people are starting to appreciate more that it's not a great rate if you can't get it, right?
Yeah.
And the fact that we're already at 2s, 2.5%, 3%, then it's actually pretty cheap, and people are really wanting to get into the market rather than just absolutely get the absolute finest rate. And that they're starting to appreciate that there are so many other important considerations, like the structure, like LVR, and
the flexibility of the lender.
Correct.
You know, cash out
Features,
policies, you know.
offsets,
Yeah.
all of that kind of stuff.
Because people are under the impression that if they've got an amount, a portion of equity within a property, that they can just draw it down, with an application and approval and what have you. But they can just draw that down and do whatever they want with it. But that has changed over the last couple of years.
Yes.
You may still have that equity in that house. You still might be able to get your hands on it, but whether you can use it.
You're right. It used to be a foregone conclusion. You know, if you had the servicing, if you had the equity, you basically signed the application form in the finance contract and that it'll be approved. But what happened after the APRA and the Royal Commission is that lenders are scrutinising the purpose for the equity releases. So a lot of lenders, especially when it's over 100,000, they're really going to ask you clearly to tell them what you're using it for. You know, a lot of them will, before they release the funds, they'll require, or even before they approve it, they'll require a contract of sales. So, because you said, oh, you're going to be buying a property with these funds, Steve. Show me the contract of sales. And, you know, you can't have it just sort of sitting there like you
So
did.
gone are the days when everybody was drawing down equity and buying Bentleys. And
There you go again.
that was my in. I started that 5 minutes ago.
So if you look at where people are at this point in time, it's more solution-based lending than anything else that they should be focused on, isn't it?
It has to be solution-based lending because there are so many other considerations other than the rate, like you said.
I think that's probably a better topic other than the one we talked about before, is solution-based lending, because it is. It's not any finance, anytime, anywhere now. It is for...
It's about
a solution.
the property. It's about turnaround times. Yes, it is about price, but it's also about the structure. You know, are you looking at fixed versus variable? Do you need an offset account? You know, are you looking at deductible debt or non-deductible debt? Are you looking at principal and interest? What LVR? Because a lot of the times, the product and the constraints are tied to, you know, is it an 80% lend? Is it a 90% lend? These days, there are quite a lot of lenders that are trying to attract business. If it's a low LVR, you know, if it's 60, 70%, they'll give you additional discounts. So,
Yeah, right.
Yeah.
So I've got to, before we get into the topic and the 5 key points, just a few questions that I'd like you to answer that we would get on a daily basis. And the first one is around offset facilities.
Yeah.
So in the most simplistic way, explain an offset facility and how it compares to principal and interest repayment types.
Yeah, so an offset is a super handy facility. You know, like if you've got a loan or if you're taking out a loan, then like if you're going to have any sort of, minimum amount of savings, 10, 20K plus, then you really need to be considering whether an offset is for you. And most of the time it will be. An offset account is just a bank account that is linked to your home loan, and any money that you've got in it effectively reduces the balance of your home loan. So for instance, if you've got a $500,000 home loan and you've got an offset account against it, and you've got $100,000 in the offset account, you're not paying interest on $500,000, you're paying interest on $400,000. Now, why is it such a great thing? It's because instead of putting your money in a high interest account where you're going to get 1% if you're lucky and then get taxed on it at your marginal tax rate, you put it in the offset account and you're saving whatever the interest rate that you're paying on that loan is. You know, might be 2%, 2.5%
net.
But it's net. You know, it's after tax.
I think it's one of the best products.
It is absolutely one of the best products.
Yeah, in the finance ecosystem that's ever been invented. And I would say that it's probably part there of the reason as to why, as a nation and of mortgage holders, I think for the most time since the 70s, we're more in front of our mortgages, because it gives us the ability to dump money into that on a daily basis.
That's right.
And you should.
Yes.
But we've also got the ability to be liquid.
Yeah, absolutely.
And to pull it back out, as opposed to a principal and interest component where we are tied to that no matter what our personal cash flow situations are.
And not only does it allow the benefit of repaying your loan faster and saving interest on that front, but it's just so handy from a banking perspective. You can pay your credit card off from it. It's like any other transactional account. Like you can have direct debits, you can have your Netflix coming out of it, and gym membership and so forth. So it's just super handy. You can have your pay come in from it. You can have multiple offset accounts. So a lot of people like to budget, which is a great idea. Having different accounts for your different allocations,
different buckets.
Different buckets.
Yeah.
You can have a holiday account. You can have a long-term savings. You can have an investment. If you run a small business, you can even have one allocated for your small business.
And it goes on. It's a great product.
Exactly. Yeah.
And I think it has reshaped the way that people think about their personal finances and then how they allocate those funds accordingly in terms of liquidity.
Just got to be a little bit careful when using them. Use them in the right way. You don't want to kind of muddy the waters necessarily. For instance, if you're extracting equity, you don't want to necessarily dump all of those funds straight into an offset account, because it can impact your deductibility. Speak to your accountant, disclaimer around that. And also there are restrictions on which loan products you can have an offset account. It's for instance fixed and so forth. Yeah.
And it's for the disciplined.
Yes.
If you are not very disciplined with your money, it's probably the worst product that you could have.
Yeah.
Stick to P&I. The other question we get asked a lot is around LMI. So lender's mortgage insurance. Should I go 80? Should I go 90? And there's a bit of narrative around at the moment, depending on the price bracket, that 88% is kind of that sweet spot.
Yes.
But we hear terminology around 88% plus MLI or 88% and cap the LMI.
Yeah.
So can you explain the 88% plus cap the LMI?
So basically you're just borrowing the LMI. That's what capped means. The 88% plus LMI at that LMI bracket, that LVR bracket, 88%, it's about 1.5%, 1.4% of the loan that's what it's going to cost you in terms of mortgage insurance. And the reason that's a sweet spot is because you've got a 90% lend. That a lot of the times lenders are happy to lend you 90%, but instead of lending the full 90% and then paying the mortgage insurance on top of that, in which case the LMI a lot of the times exceeds 2%. So you're saving a significant amount by just putting a little bit more deposit. So a 12% deposit. I'm good at maths, I promise.
Great broker this time.
So putting a 12% deposit instead of a 10% deposit, but instead of paying the mortgage insurance out of your pocket, you're actually borrowing it instead, and you'd save almost 50%. 40 to 50%.
So you're
on
preserving
the
the
LMI
capital
premium.
position somewhat.
Yeah, you're preserving the capital position, but you've also got the best of the other world, where you're minimising the LMI premium.
Yep.
Where for a $500,000 purchase, it might be a $10,000 LMI premium if you borrowed 90% and then paid the mortgage insurance. But by putting that additional 2% and then borrowing the premium, the LMI premium is only about $6,000.
So that's a huge difference.
That's a massive difference.
Yeah, it's almost the equivalent to $100 a week of rent. Almost.
Exactly. Yeah. So if for the listeners that are just starting out their journey, LMI is lender's mortgage insurance, and it actually protects the bank, not you.
Yes.
So you are paying them the privilege of lending you money at a higher loan to value ratio, the LVR.
Yes.
I guess one way to look at it is this is a business proposition where you're using less capital to get into a income producing asset.
Correct.
It's a cost of business.
Yes.
At the end of the day, and that's one of the remarks that we often give is, why would I pay LMI? Well, one, it's to make that dollar of yours go further in terms of your capital position, but it's also a cost of business.
And because it's a cost of business, it's also tax deductible over 5 years.
Yes,
correct.
So that way it sort of hurts less. And if you're looking at the opportunity cost, if that's allowing you to get into another property instead, or even
into a property rather than save the deposit. But we do need to move on. So let's get to the subject, which we kind of are, and it is those 5 absolute finance musts for finance solutions. Is that what we called it before?
Lending solution?
Lending solutions.
Solution lending.
Solution lending. And
We've got our stuff together here, folks. So bear with us.
preparation was key. All right, the first one is around non-deductible debt. Is the point you've made, and I'm guessing that is really minimising stuff like car leases, car loans, credit card debt.
Yes, all of that hurts your serviceability, and even if you were to compare owner-occupied debt to investment debt, $500,000 of owner-occupied debt doesn't translate from a borrowing capacity perspective to $500,000 of investment debt, because the investment debt is actually treated a lot more favourably by lenders when they're calculating how much you can borrow, because they know that you're getting a tax benefit, right? They know that the rent's generally going to be a lot less than what you're going to have a lot of other expenses. So they're actually helping you by adding back some negative gearing benefit, they call it, to your income to actually help you supplement that debt.
It's an interesting point. So essentially investment debt is looked upon more favourably.
Correct.
Than the owner-occupied debt, generally speaking.
So that's one of the real key principles of lending, especially when you've got an owner-occupied debt, and a lot of our clients are in this situation. They own their home, they've got a mortgage on it, and they're buying investment properties. They've got some investment properties, or they have the objective to buy investment properties. So many of the finance strategic decisions are centered around that kind of non-deductible deductible debt kind of relationship. So, for instance, why would you want to go a 90% lend or 88% plus LMI when you've got enough equity or you've got enough deposit for the 20%? It's because you're trying to preserve your deductible debt.
Yep.
And same with P&I versus IO, so principal and interest versus interest only. When you're taking on that investment debt, you'll hear a lot of people say, "Oh, investment debt, just take it out as interest only." You might be questioning why that's the case, especially when interest only is usually a little bit more expensive than the P&I. It's because you're maintaining those that interest only and deductible debt, and you're not paying it down, where you can take that disposable income and use that to put in your offset account or pay down that non-deductible debt, which is going to help you grow the portfolio going forward.
So you're committing less of your cash flow towards the loan repayment as well. When
towards the investment loan repayment. And then you can obviously make additional repayments to your home if you like, because it's non-deductible.
Control the cash flow, control the opportunity at the end of the day.
Good way of putting it.
Yeah. Non-deductible debt is also around, as I mentioned earlier, on car leases, credit cards. And I don't think people have a real understanding of just how much that affects potential borrowing capacity. So and we did this on a Facebook Live the other day, but let's do it again.
Yeah.
If I have a $60,000 car lease,
yes,
how much is that taking away from my overall capacity or borrowing capacity?
Yes. So it's $60,000, roughly you're looking at about $1,500 a month in terms of, depending on the interest rate and terms and loan term and so forth, but you're looking at about $1,500 a month. So that's probably taking anywhere between $300,000 to $400,000 additional.
So
that's another property.
Yeah,
isn't it?
I just want to say that again. If you've got a $60,000 car lease, which for some people it's a must, or for whatever the reason, but let's just keep this within context. A $60,000 car loan is going to cost you and take away from you the same of a $300,000 to $400,000 home loan mortgage.
Yep.
So take out the car lease or buy the property. It might boil down to that.
So if you play this out, Z, right? So I need a car.
Yes.
Right. And I've got the choice now to put a lease on it, or I can tack it to the back end of my home loan.
Yes.
Right.
Yes.
That would be a better option because it doesn't impact my borrowing capacity as much if I've just redrawn from the home loan, isn't it?
Exactly right. And the reason for that is because it's amortized, that home loan is amortized over 30 years rather than a 5, 7 or even sometimes 3-year loan term for.
But it will cost you more in the long run.
Yeah. So if you're disciplined enough to pay it off within that 3 to 5 years.
If you quarantine it, and you just say to yourself psychologically, I'm going to smash that part of that loan down, so be it. But the point I wanted to make was that it's $300,000 to $400,000 worth of borrowing capacity you are throwing away with the $60,000 car loan.
So we were talking about visualization earlier on, if I can say that word. If you can visualize the car that you're driving is $60,000 finance. You're driving a house on the road.
Yeah.
No more to pay.
What's going to appreciate more?
Well, that's the difference between constructive debt and non-constructive debt. Appreciating debt versus non-appreciating debt.
You're right. You're not getting a tax benefit on the car, but if you're PAYG, let's say, but you're getting a tax benefit on the house plus appreciating and depreciating. It's kind of a no-brainer.
Yeah. Now, we're not saying that everybody should get around in a Datsun 180B for those that remember what it is, but you need to be tactical. If your goal is to build out a portfolio, whether it be 1 or 100 properties, you need to be methodical, tactical, and think well ahead of what steps you're going to do today to enable you to be into that position tomorrow.
I think Vic had a really good solution. You split off part of your home loan. It's really easy to do from a finance perspective. Split it off and then you concentrate on paying that down. And even if you're making additional repayments on that and consistently, because the minimum repayment is so much less than the lease or the novated lease, the chattel mortgage or whatever it is, then you're still paying that down and getting rid of it, but you're not impacting your borrowing capacity.
So that would be the same with credit cards as well.
Yep.
So if you've got a $5,000 credit card, you're potentially taking $20,000 to $25,000 away from your borrowing capacity.
Yes, that's right.
It's crazy. Absolutely.
And even in that situation, even though it's a bit counterintuitive to say, well, take it out of the equity of your home. In fact, if you are disciplined, then from a borrowing capacity perspective, it is actually better. Like for instance, if you've made $100,000 worth of advance repayments on your home loan and you take out $5,000 of that to go on a holiday when we can travel again, it just makes so much more sense, rather than racking up on a credit card.
Just be mindful not to let the debt run for 30 years once you've used that as well.
Yeah.
And if you've got $100,000 worth of equity, maybe think very carefully about how much of you use to buy the car. Instant gratification versus not. Like, I'm not a fan of any non-deductive debt. I don't like it. I don't have a credit card, don't have a car loan. I'm not a fan. That's me personally.
He doesn't even have a car, folks.
Oh, that's
why you didn't want to pick me up earlier today. You walked.
Well, I figure, why have a car when I got old mate here with a Bentley and he can drive. And he can cop all the debt. All right, next one, we move on. So non-deductible debt, that was point number 1.
Yep.
Point number 2 is repayment structure. And you touched on this a little early, but this is such an important component.
Yeah, the whole finance product. Which product is most suitable for not only your current situation, but what you're wanting to do in terms of goals, but also from a property perspective. If you guys are buying my client a property and your intent is to do a major reno on it and then flip it within a couple of years, ride this market and then flip it in a couple of years, why would I put them in a 5-year fixed period, for instance?
So the plan on the property needs to be looked at as well.
It has to be incorporated.
And that could go down to whether I stay fixed or variable. So let's use that as an example.
Correct.
Not the flipping, but let's just say we want to do a major renovation because that's the way we've purchased it. There's great upside, etc.
Yeah.
Then it would be imperative that I kept variable because I'm going to want to equity harvest later.
That's
so
right.
I need the ability to be able to move lenders, because the chances of the lender I have at that point in time giving me a more favourable valuation than the next lender is minimal, and I can hear the phones ringing now with valuers complaining.
Well,
but it's the truth.
It's true because again, the lender's going to look at it and they said, oh well, a month and a half ago, we bought this property for you for $500,000. How can it be worth $650 now?
And they're about minimising their risk. And if they have you fixed and you can't go anywhere, well, why are they going to bend backwards for you?
Exactly.
Like, you're the perfect client
Exactly
for
right.
them. Yep.
Exactly.
So The repayment structure, so what we're referring to there is fixed or variable, P&I versus interest only.
But just on that point, we're not necessarily saying fixed is bad because, for instance, right now a lot of the fixed rates are a lot better than the variable rates. We just had word a couple of the majors dropped their fixed interest only to under 2.5%, 2.49%.
Don't be saying that to me.
It's a sore spot.
Yeah, very, very sore spot. But with the fixed and variable, it comes down to the plan for the property.
Yes.
Always.
Yes.
As I said, it might be a renovation, it might be a secondary dwelling, it might be an equity harvest scenario. But we need to weigh that up heavily with what the physical cash flow savings are as well by fixing, because they are smaller.
I suppose it also needs to take into account the bank's policy, the lender's policy, whether they will actually allow you to come back pretty much straight away and harvest the equity, or do they have any rules around it to say you can't do anything for 6 months, as an example?
Yeah.
All right, so repayment structure. And the next one is something that not a lot of people talk about in terms of other brokers and why it's such an important part of the 5 absolute musts, and that is equity harvesting.
Yeah.
And how that can actually benefit you moving forward.
Yeah, I think we touched on it earlier in terms of extracting equity, but because in today's environment with the turnaround times how they are, it's even worse for equity harvesters, if that's a term it is now.
It is now.
But if I'm going to the bank and I'm saying, hey, I want to take out $150,000 of equity, like the banks are actually deprioritizing that. Even if you have a pre-approval alongside it, they're like, yeah, we'll get to it when we get to it. I can see that a lot of other customers have bought a property, they've got that contract of sales, they've got that deadline, that finance and that settlement date. We're going to push those. So you get sort of put to the back of the queue.
Because you're not as profitable as the new person.
Well, it's more that there's less urgency around that deal.
There's no timeline on it.
So there's no timeline on it. Our ability as brokers is very limited to be able to push it. We leverage our relationships with the banks, but at the end of the day, they're going to say, well, okay, give me a reason that it's so important and so urgent, and you can't. And then they're like, okay, well, we'll shuffle that, and our turnaround times are 4 to 6 weeks.
So the reason for me why equity harvesting is so important is it's not about the now, it's about the future. It's about the tomorrow. Because our credit file or our credit rating is just the most important part to us, that anyone that wants to borrow money. For me, equity harvesting is about creating buffers and mitigation around a point in time that may never and probably will never exist, but at least I've got it covered. And what I mean by that, if I lose my job, if I sack myself, or something goes wrong and I still need to pay the mortgage, I still need to pay the phone bill, whatever it may be, I'm not going to have an arrears red mark against my, whatever the credit policy is, mortgage, phone, car payment, whatever. I have the money before I need it. And I think that's the key for me.
And that's the key.
Have the money before you need it.
It's a risk mitigation.
It's liquidity is just such an essential part of any investment platform. It's like the reason, if I pivot a bit, the reason they say, that the people that invest in shares heavily, one of their major arguments is around, well, shares are more liquid. Well, here's a way with the invention of the offset facility, redraws, lines of credit, whatever it may be, and being able to put it back into itself, so minimal to no cost unless you use it.
Yes.
Here's your way of being liquid to some degree.
Yes.
In other words, have the money before you need it. That, for me, that's equity harvesting is not just about being able to reach back in, and this is what equity harvesting is: reach in, take some equity out, or recycle capital
Yes.
to then duplicate.
Yep.
It's about also being ready.
Yes, and it's being about being opportunistic as well. We've seen it for your clients, and that you have that $300,000-$400,000 equity, and worst case, you're not going to get another extension on your finance. You make the call that worst case, if we, like all lenders say no, I can still buy it cash outright, or I can buy it at a much lower LVR because, you know, it's a fire damaged place, and then, you know, I can use that to leverage and then pull the equity out once the major renovation's done.
Yeah, it gives you a lot more options as to what you can do with money, play around with the opportunities that come in terms of today's market.
Yeah.
Yeah, and even if we use an example not quite as extreme as the fire damaged property.
I think you've just pulled one out of your portfolio.
I know, that's what I thought.
Personal experience, maybe.
Yeah, but it's more around what happens if the pre-approval I had at 90% now no longer exists because there's been a policy change. But they'll give me 80.
Yeah.
I'm
And
ready.
It doesn't even have to be a policy change. It might just be at the behest of the lender. You know, we know many lenders that they give the power to the assessors to arbitrarily change the product on you. So, you know, you go to unnamed bank, I'll not name and shame at this point, but they go, okay, I can see that you actually qualify for a 90% interest only. You fall within the policy, and, you know, it actually meets our rule book. But I don't know, you know, the fact that you bought a Bentley and, you know, it just doesn't sit well with me. So I'm going to just mark this down to an 80%.
Because I can.
Because I can.
Correct.
And, you know, they've got the full power to do that. And there's nothing that you can do to counter it. You can't argue their policy. They say, I'm aware of my policy, but just based on my own risk appetite, I'm a credit assessor. I have the discretion to do that.
Now, if you weren't using a broker in that scenario, you'd have zero chance.
Yeah.
But if you're using a broker that will physically go into bat for you, there is some
We can argue it, we can leverage our relationships, and worst case, we can go, okay, no problems, let's go to another bank.
Correct.
That will do it.
Yeah, but if you only think Bank One exists because that's where you've banked all your life,
Yes.
well then, yeah, you're kind of cornered. So once again, that whole equity harvesting is not just about the propulsion of your portfolio; it's about protecting your position.
Yep. It's forward planning to be
Always.
opportunistic. Yep.
So the next one for me is an obvious one on the surface, but when you dig a little deeper, it's not so obvious, and that's around income. Clearly, the more you the more you earn,
Yes.
potentially the more you can borrow. But it does come down to your disposable income, you know, what expenses you have personally and within your businesses or your portfolios or whatever. But income is a major component.
And it depends on the type of income. You know, some lenders are good at different types of income. For instance, you know, if I'm a real estate agent and I'm earning very heavy in commissions, or, you know, I'm in sales, I've got a lot of commission or bonus income, then some lenders will shade that significantly up to 40%. So they'll actually, you know, say, oh, what have you earned over the last 2 years in terms of bonus? We're going to take the lower figure per annum, and then we're going to shade it by another 30% or 40%. And then all of a sudden, you know, you're not actually showing that much income. So it's about using the right lenders, and I know that was probably a good segue into the next point around lender selection, but it is so important which lender that we go with, because different types of income mean different things. You know, self-employed income, how do we assess that? You know, is it over 1 year? Is it over 2 years? Financials, or is it just over a BAS statement or 4 BAS statements and an accountant's declaration?
And that's the difference between self-employed and PAYG, but we'll get into the next one, which is lender selection. But
so one of the things, Steve, if I can interrupt, is the biggest difference I see between someone going direct to the bank or using a broker is the broker understanding the lender's lending policy and then matching it up to the circumstances. Whereas most people, when they're starting out on investing, they go to the bank they've always banked with, as you said, and they're then only focusing on the interest rate and I've banked with this bank for years, so therefore I'll be loyal to them, not understanding their particular lending policy. And this is where a good broker comes into play and matches what we're trying to achieve with the actual lender's lending policy.
I think even before that, though, you need to know where you want to go.
Yeah.
Then the policy will be matched to where you want to go, as long as you've got the right people around you to clearly define and help you understand where you want to go. But if I just come back to the income thing, or the income point, income for me is also about expenditure.
Yeah.
So it's all good. Earn $500,000 a year, but if you're spending 400 of it, well, you're in no better position than the person who earns 70 and spends nothing. So it really does come down to not just asset selection, product selection. It comes down to the person who you're sitting in front of to actually give you the steps to rein in where you necessarily have to be in a position to be able to borrow. And sometimes you can't see that yourself. You need someone to say, look, maybe we've got to shift this, pay that credit card down, switch that car loan. So it's a unified effect, if you will, to get the result. But expenditure is the easiest way to increase income.
Yeah. And that's not to say that you stop living life. Like,
God, no.
There's many instances where, it might be travel or let's just say marriage, right? Like a wedding. You see like a couple's expenditure go up significantly in the months leading up to a wedding, but it's something that we as brokers can actually explain away to the lenders. We can say, look at these transactions, this is to a reception center, this is to a photographer, they're one-off expenses. Just ignore those. Some lenders might still question it, and because it's above their threshold. But again, going back to the lender selection, if we go to the right lender, they'll go, I understand. You're not getting married every year, so we can contain those.
You hope they're not getting married every year, but so they're one-off expenses. But if we're in a moment in time at the moment where we can actually start to control some of our ongoing expenses, such as our interest rates, we can maybe renegotiate. Maybe we can have a look at the broker, and the broker says, "Why are you paying 4.5%?"
Absolutely.
And let me tell you, that happens on a weekly basis, where I'm sitting down in front of clients or potential clients, and their rates are next level, above and beyond.
Yes.
So if we start to condense the interest rates and therefore our payments, it increases our income, potentially our serviceability, as does our rents. If you're a landlord in Australia within certain areas, to be fair, and you haven't adjusted your rents accordingly with the right type of asset in the right area, let me be clear, then you're leaving money on the table. Then suddenly we have the combined effect of literal increased income via our rents, and we've started to reduce our expenditure via our interest rates. And our position just might change in terms of our affordability in the bank's eyes, or our ability to be able to borrow.
And not only the in terms of the interest rates controlling your expense, it might be the repayment type as well. Going back to our conversation about principal and interest only, you might actually choose a more expensive interest only product versus then the principal and interest, but that might actually significantly help your borrowing, because the most generous lenders will look at not your deemed repayments. They'll look at what your actual repayments are, whether that's fixed for another 6 months, 1 year, interest only, or whether it's P&I at a very low rate. The P&I might still be higher, but in order to qualify, you might actually be better off on the more expensive interest only rate.
So the physical repayments, so let's say it's a 2.5% P&I,
yes,
may be higher than, say, a 3.5 interest only payment.
Correct. Yes. Yes.
All right, the last one is lender selection and asset selection, but we'll leave the asset selection up to us. Let's talk about the lender selection and why that's so important, which we've kind of touched on on each of these points in a little earlier on, but let's get a little bit more granular.
I think that ties everything together. The right lender will give you elements of all of those things that we spoke about, in terms of being able to extract that equity, treating your income and your expenses to maximize your borrowing capacity, being able to allow you to extract the equity, giving you the right products for the right rates, because one lender may be an amazing owner-occupied P&I. I get this all the time. I get somebody saying, this bank is the best because their rate's 1.89%, but that's an owner-occupied P&I rate. If you're going for an investment interest-only rate, their corresponding investment interest-only rate might be over 3%, where there's others that are well under 3%. So using the right lender from a credit perspective, from a turnaround time, we've spoken about that, a policy perspective. I mean, it might even just come down to banking. If you're buying your first investment property or your first property, you're probably going to want to go with a lender that, it may not be the absolute cheapest on the market, but for an extra 10 basis points, you've got a full branch network, you've got a full suite of products from a banking perspective, you've got the offset account, the ability to do multiple offset accounts. That bank will allow you to do free valuations when, we go back to extract equity and so forth. So lender selection is absolute paramount.
And we're seeing that now in just the different product types or the proposals or scenarios, as we like to call it. And and a good broker should give you a few multiple scenarios to make a very informed decision. But we're seeing the first tier lenders or the big four that are coming in with higher rates.
Yes.
Maybe same loan to value ratio,
Yes.
but their proposed loan amount is remarkably different from the second tier lenders.
Yes.
Because the second tier lenders are more aggressive in the market
Yes.
at the moment. We don't get these moments in time very, very often. I mean, very, very rarely are all lenders on the same page at the same time.
Yes,
But when there's a remarkable difference like we have today, it's a really good time to potentially reassess what you have and move products or move lenders or just rejig what you have.
Yeah.
And you're going to need a broker to do that.
Well, as a broker, we're now legally obliged to give the clients or to act in the client's best interests. So that legislation was passed in 1 Jan this year, and we actually need to show that we're actually acting in the best interests of our clients. And that's not necessarily, like you guys said, just the best interest rate. It could be borrowing capacity, it could be turnaround times, it could be amount of extra equity, could be credit policy, what have you. But we are actually legally bound to get the right lender,
which is a little bit different from what some people think. Well, they'll just put me where they get the most. Where they get the most money. The levels of compliance today,
yes,
is so onerous compared to what it was just last year or 5 or 10 years ago.
Yes,
that it's a healthier banking and lending environment.
It is, and the reality is that the differences in commissions, for the average broker, it wouldn't even be a consideration. It's just such a small difference. It's like, doing the right thing will always ensure a more sustainable and better relationship with your client.
There it is.
So we can't let you go without asking the changes that were flagged in terms of lending. That March was supposed to be this magical month where these changes were coming in. Yeah. Have you seen any changes come through?
They're starting to trickle through. So initially, at the start of the year, it was mainly the third tiers, the non-bank lenders that were kind of they were responding to their initial response from COVID, where they had a knee-jerk reaction. They a lot of them kind of shrunk back and didn't do good pricing, didn't do good policies, and then they're starting to sort of relax their policies. I didn't really take too much from that because they're kind of up and down anyway. They sort of come in and out, but only just this week we got a couple of very interesting changes from the banks. Like we said, it's not the wholesale, open the floodgates type thing. It's nothing to do with servicing. Although there have been some tweaks to servicing that, assessment rates and benchmark rates and so forth, they've come down a little bit as rates have been coming down. They've naturally been being reflected in the serviceability calculators, and there have been over the last couple of months, to be fair, there have been some minor tweaks in that space, but we're not talking about $400,000, $500,000, $600,000 changes in borrowing capacity. We're talking 50, 100, 150 maybe, but just recently, there's some really positive news from CBA. They've said, if the servicing is quite comfortable, i.e. more than $500 surplus per month, then they don't require verification and evidence of account conduct.
Right.
So you don't have to, if you've got a heap of accounts, you don't have to show everything for the last 3 months.
The paperwork will be a lot less.
Paperwork's going to be a lot less, which is going to really help in the turnaround times and the assessment process. So that's a real positive. And they're kind of leveraging off the whole comprehensive credit reporting regime that's come in over the past 12, 18 months. So they can see it there. They go, yep, no problems. We don't need to kind of make sure that you're conducting your accounts and your loans well, because we can see that in your reports anyway, which is going to cut out, I would say, a good 20% in terms of the effort from an assessor going through all of those things, because they have to go through line by line. And if you do a lot of transactions, if your account's 3 pages long of size 8 font, they're going to have to go through everything just to make sure that there's nothing wrong. And that's that's one of those things that's holding up turnaround times at the moment. So that was one big thing. Another one was CBA said you don't need to show that you've got the physical funds for a deposit. As long as it's less than 90% loan, then and you're declaring that you're going to have those funds in your account by the time it's ready to settle, the property's ready to settle, we're happy to
That's a big change.
Yeah.
Huge.
Yeah, it is. So, there's, although it's not, as I said, those massive wholesale changes yet, and I don't think that it's going to be, as long as the property market's running as fast as it is, I don't think we're going to see that. I think it's just going to be the tinkering around the edges, slowly making it easier, slowly making it faster. We had a little bit around self-employed income as well. Some mains, another major Westpac saying that they were going to take the latest year's income if it was more favourable, rather than instead of having 2 years and then taking the lower of the 2 years or the average of the 2 years, that they were like, okay, if FY 2020 was better, even if it was significantly better, we're actually happy to accept that, subject to few other conditions.
And it's these little minute, softer changes that may encourage other lenders.
And
to do
because they're coming from the majors, the second tier will follow after that. And I think I'm a lot more assured that I actually think the government's doing it in the right way. It's kind of focusing on the issue of credit being hard to access in terms of it's such a lengthy and painful process. They're addressing that, but they're not opening the floodgates, perpetuating a bubble.
Nor should they.
No, I agree.
Yeah, we don't. We want a sustainable market. We don't like the bubbles and the massive deflation periods as well. We just want it. If it was nice and linear, that'd be awesome. But it's
8% a year, thanks.
that'd be great. But we know that that's not the case. But there it is. 5 really important facts that you need to do to preserve and enhance borrowing. Lending solutions. It's
solution-based lending.
Solution-based lending.
So, Z, for the listeners, if they wanted to get in touch with you, how can they get in touch with you?
Please, mlsfinance.com.au.
Yep.
There you go.
And their name and number. Contact details will be there. Lots of really well experienced brokers there. All of them are investors too.
Yeah.
So it, which for me is a really important point, whether it's an accountant, an advisor, a broker, whatever it may be, I want them to experience the same emotional roller coaster that I'm about to experience. And as a side, anyone who says that take the emotion out of investing, it's not, they're either a narcissist or it's just not physically possible. When you've got $500,000, $750,000, $1 million on the line, there is an element of emotion there. Don't let anybody tell you any different. Just surround yourself with some people that can keep you in check. All right, there it is. Thanks, mate. Thanks, Steve. Thanks for coming along. Thanks, Vic.
Thanks for having me.
We'll be back in a couple of weeks with Phil Tarrant to do the podcast version in their office. No doubt between now and then there's going to be so much more news, and we've got our regular Facebook Lives, where sometimes Zee's a guest there as well as other people. So make sure you tune in, and you'll get all of that off from our socials and our website, rightpropertygroup.com.au. Thanks, guys, and we will see you soon.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.